The markets have decided that this U.S. Fed outlook is okay. That's the story that we have here from financial markets in the wake of very much anticipated U.S. inflation data. We'll get into what that meant momentarily and whether that gives the markets any semblance of lasting clarity. But aside from what happens when that dust settles, today's price action creates an opportunity in a wholly other corner of the financial universe, and it's entirely separate from stock markets. That's where we're going to go today here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and what we're going to explore here while stocks digest is where the markets sort of signaled they want to go from here, but moreover, where there might be opportunity to utilize the insights that we had from today's price action, even as the markets try to figure out what all of this means for Wall Street. Because what we have in front of us now is a monetary policy announcement across the Atlantic from the European Central Bank and an opportunity to see what we've just learned about the Fed after today's data put to practical use in currency markets. So first, let's consider what it is that we saw in response to US CPI today. This is a 15-minute chart of the S&P 500, the front month future, the active September contract here. And what you see initially starts to follow a familiar script. The numbers come out basically in line with expectations. So you get a slightly cooler number on the headline inflation, 2.5% year on year versus 2.6 expected. The core number, which is the one that the Fed really cares about, excluding more volatile food and energy, where, of course, the Fed, first of all, has no agency to have an effect. They can't exactly mandate global food prices or global energy to go this way or that. But also, because most of the lingering inflation that we have to combat is stuck overwhelmingly in the service sector. And so the Fed cares more about that core reading. And here we had a 3-year low at 3.2%, a repeat of what we saw in July and exactly as expected. So no real change here from markets. And the expectation that we had going into this was that such results would give you something akin to what we got with last Friday's NFP report, last week's ISM surveys, where the market thought the Fed was behind and that its rate cut cycle would be slow and much more gradual than the situation calls for, and that this would put the Fed behind the curve in terms of combating some sort of an economic downturn. This was very clearly evident because the market still held on to a 30% chance that there would be a 50 basis point rate cut next week rather than the regular 25, and that when you look at the way the markets have behaved on rate expectations since that panic on August 2nd through the 5th, the outlook for this year held relatively steady and hasn't come back to those panic levels. But the one for next year added an entire extra rate cut between the beginning of August and now, essentially saying the markets fear the Fed is late and they have to scramble and cut faster next year. And that, needless to say, created a level of concern. So when we got as expected ISM numbers, when we got as expected NFP numbers, give or take, that sustained that ambiguity about whether the Fed would actually have the 50 basis point cut for us next week because they too have recognized that they're behind the ball. The markets didn't like that ambiguity and sold off. Well, we got basically as expected CPI data here, and the initial response, as we can see, was on script. Stocks sold off. And then after a little bit of time, after about an hour and a half of selling, they stalled and rethought things. And what's interesting here is that there wasn't really anything in particular that triggered the rethink. Except what we see now is that the probability of that 25 basis point cut is 87%. That's up from 66 yesterday. And so what we're looking at then is a situation where the markets have seemingly embraced the idea that the Fed is going to have a smaller size cut and that this is okay. That this is not the source of worry, that an analogous NFP data, analogous ISM data marked last week. So what we see is that we bounce from support right above that 54 level on the S&P. It's unclear whether we're out of the woods on what has been a series of lower highs here for overall sentiment. We're still coming into the underside of where we had range support that we've just taken out on the downside. So who's to say that this finds follow through or it doesn't? But what we can certainly say is that the market looked at CPI data that did not give them clarity and decided to make that clarity themselves. And to say that we are going to have most likely a standard size cut and that this is okay as far as sentiment is concerned, at least today. The important nugget here for us, while stocks figure out whether this is a rally that's going to keep going or it's going to run into the underside of former support become resistance, incidentally, just like it did here, and this is going to round out a top that then gives us the next leg down. While stocks sort all of that out, the important insight for us here from a tradable perspective is that the markets now have a very convincing perspective on what the Fed will do next week. The level of conviction has swung firmly in a direction. And what this does is make for a very clear contrast between what the Fed is doing and what's about to happen, perhaps, across the Atlantic for the European Central Bank. And in that disparity, there is a yield spread lead, perhaps, to trade something wholly other than stock markets. So the ECB is set for their policy meeting over the course of the next day here. It'll be overnight for the U.S. and Thursday morning for the European time zone. And what we have here is a very firm expectation that the ECB is going to cut rates again. As we can see here, we're down to a rounding error on the benchmark ESTR interest rate futures. The move expected here baked in to the tune of 19, I should say, basis points. So that's basically coming down to a 72%, 74% chance that we are going to get this rate cut, which is quite convincing, a single one to 25 basis points. But where this gets interesting is we've just heard a round of commentary from the European central banks assorted officials, most notably at the Jackson Hole Symposium, where everybody was so busy listening to Fed Chair Powell that they paid relatively little attention to what ECB officials were saying. But nevertheless, they were out there signaling that maybe a 50 basis point cut is appropriate for them, perhaps as soon as this month, but certainly at some point in the near term. And what we see here beyond the almost certain move down in rates, at least by 25 basis points this go around, is that the tally through the rest of the year is only 58 basis points, which is to say there's two cuts that are on the board that might be spread across September, October, and December somehow. That's when the ECB has meetings. If the ECB were to do a 50 basis point cut in September, it would ostensibly do nothing in October and December if this total is correct, or the total is incorrect, which is to say if the ECB is indeed so minded to do more easing, to have a 50 basis point cut at one of its next three meetings, including the one today, well, then we're probably not getting just 58 basis points in cuts. It might well be something closer to 75. It might even be more than that, depending on just how dovish the ECB is willing to go here. And what we can see is since the last ECB meeting in mid-July, the path from September is where the main divergence is. Here we're about set for this 50 handle on the rate. That's a 25 basis point cut. And again, this extra 6 basis points here is almost certainly just a rounding error. This is just the straight quote. It doesn't do the added math of dialing up the probabilities to the precise September 12th date of the announcement, which probably gives you how you end up at 56 rather than closer to 50 on this implied rate here. But it's after this that things diverge, and as we can see, since July and certainly since June, the pathway has become more dovish. Nevertheless, still only 2 cuts and change baked in for the remainder of the year, and in fact, the probability of that third cut is only 32%. So we're perhaps due for some kind of a rethink on this if the ECB signals a more dovish posture. And they've certainly previewed as much, and they certainly have the wind at their backs, as it were, from a data perspective. Looking at the latest numbers for ECB input number one, they, of course, have only one mandate, to get inflation to 2%, unlike the Fed, which targets both inflation and employment. We have a slide down to 2.2% on the most recent August number. We don't quite have the components of it yet. That's coming when the final numbers are released. But what we certainly see is that after a period where basically for the first 6 months, much of the first half of the year here, inflation was basically idling, you now have resumed with some vigor a disinflationary slide. And if we will look at the latest numbers that we have on the breakdown of the components, we can see that the disinflation has been fairly broad-based. The last big area of stickiness in inflation comes from hospitality. And this is, of course, something that's very amenable to pressure as a discretionary spending item, both to seasonal factors. Needless to say, the summer is a big hospitality spending month, especially in Europe, but also as a discretionary spending category, it is sensitive to the economic cycle and people's willingness to spend on discretionary things. We can see here that although we've seen a little bit of a perking up in Eurozone economic activity in August, we are still well below the peaks of this catch-up rally in growth. This is, of course, S&P Global's Eurozone PMI. The manufacturing sector still anemic, we can see here. Services really doing the heavy lifting. As ever, numbers above 50 mean growth, below 50 mean contraction. And the faster you go above, or the further rather you go above 50, the faster the growth. The further you go below 50, the faster the contraction. For manufacturing, we're then contracting, but the pace has kind of evened out since the beginning of the year. For services, we were in recession-like conditions when they, along with manufacturing, were sub 50, but we had a rally here at the start of the year to recover from this state of affairs, and that rally has now fizzled. So we're pinned closer to standstill on Eurozone growth than we are to the peaks we saw closer to mid-year. So the situation economically in Europe looks anemic, and therefore the discretionary spending nature of where inflation is sticky suggests the anemic economy will invariably come for it. So the ECB seemingly has the backstory here to continue cutting. We also see here that Eurozone economic data has increasingly disappointed relative to forecasts recently, and by a widening margin, which suggests that momentum is not on the side of the hawkish perspective for the ECB. Not only do we have growth that's closer to standstill than it is to something more vigorous, but incoming economic data suggests a sort of weakness in the tilt, in the tone of data outcomes, which means that we're maybe closer to seeing more stagnation rather than less. And so perhaps if the ECB doesn't have enough evidence here, it isn't going to move on the full 50 basis point cut this time. But their rhetoric can certainly make such an outturn appear more likely either in October or December than current market expectations, tuned as they are for only 2 cuts, seem to suggest. So there is an underpricing of dovish risk here, as it were. Or at least there seems to be one. And where this becomes most interesting is, of course, in trading the exchange rate between the euro and the US dollar, in trading the currency markets, where for the euro, the story has very clearly followed near-term yield spreads. We're looking at the exchange rate here of the euro against the US dollar in the darker line, and the spread between benchmark German and US 2-year yields in the lighter line. And what we see is that since the beginning of the year, these things have moved very much in tandem. The euro has enjoyed a bit of a rally here from about mid-year or so, as we have seen the markets become increasingly more dovish on what the Fed is going to do. And of course, this is very much a part of this concern that maybe the Fed is behind the ball. So the tally of rate cuts expected really since mid-April or so back here, where the Fed is resisting rate cuts even as the economic data in the US is turning sour, that gives us a yield spread marching in the euro's favor. Because while the ECB actually started to cut rates in June, that rate cut was overwhelmingly expected and almost pre-announced for months So there really was no surprise there, and the object of speculation really came down to what was going to happen on the Fed side of things. Well, now we seem to have locked that in. Now, as we've just looked at, the markets are overwhelmingly thinking we're going to get one cut, but what we're going to get from the ECB now becomes a little bit more clouded and now becomes perhaps a little bit more tilted in the direction of the need for a dovish adjustment. In fact, you can see the dollar is perking up just a tad here against the euro. And so where this becomes interesting is now that the Fed outlook is locked in and the downside risk is for the ECB, stocks might take a few days, maybe longer, maybe shorter, to figure out if they really want to make a big run of what happened today, which was unmistakably constructive. But the turn in currencies may already see some directional conviction out of the market's newfound embrace of Fed certainty. We can see here that this is the 6E contract, the benchmark for the euro. It has already taken out its most recent swing bottom just above the 110 figure, meaning that there is perhaps some room opening up on the downside for a swing first under 110. This is that first line in the sand here, and arguably the most critical one. We can see it's been in place since all the way back in March, just under 110 at about 109.85. If the ECB takes us through here, then we have room to perhaps come down to test the 109 figure and maybe even grind through that congestion into a test of 108 before there's really any meaningful thing to stop momentum. Because indeed, if the market is convinced that between now and next week, the Fed is basically locked in and we won't know more until the central bank itself comes out and gives us not only the cut, but also the summary of economic projections, the press conference with Fed Chair Powell, all of which are opportunities for new guidance, for coloring people's views this way or that. Well, relative to that, the ECB is now. And the lead-up commentary already tilts dovish, as we can clearly see in the shift in this curve from this steeper downward path to this more dovish one. And all the ingredients seem to be there. Low inflation, anemic growth, data underperforming, and of course, sensitivity to the narrative to begin with. So if the ECB, even just with forward guidance, suggests that 58 basis points is not enough basis points to put in the year-end outlook because we might get a 50 in October and December, never mind if we get one now, the euro looks like it may extend lower. And of course, if we do get the 50 now, then the euro is looking at a very significant sell-off indeed. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things might go from there. I'll be on in just a mere half hour on the Price of Truth with Victor Jones, as I am every Wednesday. I'm back on with Chris for Futures Power Hour on Fridays, back with Victor and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.